welcome back. You are listening to Benzinga's Pre-Market Prep. I'm Brianna Valesky here with Garrett Cook. We have Jill Malandrino on the line. She's the Product Development Manager for OptionsProfits at TheStreet. In addition to managing the product and content for the site, Jill is also a market site reporter for the NASDAQ, reports from the floor of the CME and CBOE, hosts the morning call for TheStreet, and the all-in-one video for Options TV. Jill, thank you so much for joining us this morning. How are you?
Good, doing well. Thanks, Brianna.
Wonderful. So let's jump into, you mentioned me you were interested in focusing on retail and consumer sectors. So if to start off, just kind of give us your overview of retail stocks right now.
I think one thing you have to look at when you focus on retail stocks that it always has been a tale of the haves and the have-nots, regardless of the up or down trend that the market may be trading in. You're always going to be able to discern the out and underperformers in the retail sector, particularly in discretionary. One area that I'm looking at for 2015 is consumer staples, and while it's not the most exciting group, I think for 2015 we're going to start to see a lot of M&A activity and these big conglomerate groups right-sizing their business. So, even if you take a look at the XLP, for example, which is the ETF for the sector, which is something that we're involved with OptionsProfits, I think that'll be a nice longer-term trade for 2015. Staples almost reminds me, consumer staples almost reminds me of what we saw in biotech for 2014, and it's very rare that you would ever correlate these two sectors, but I think you're going to see that M&A activity that we saw in biotech for 2014 certainly be the key focus for 2015. And we've seen that already with Smucker's acquisition of a $6 billion pet business, which is one of the fastest growing verticals within staples, and the big Heinz Kraft deal that was announced a few weeks ago. And I think you're going to continue to see that as these larger names continue to right-size their businesses and invest in verticals where there's growth, and those verticals being pet businesses and the organic and health craze, and you'll see them start to sort of phase out maybe some legacy brands that aren't the trend right now. In consumer discretionary, on the other side of the spectrum, I like names that are undergoing restructuring stories that are starting to play out. One of the best names that we've been trading on OP has been Urban. Over the past couple of weeks, that's a name that has continued to break through new 52-week highs. It's pulled back a bit, but once you have established those levels and you can kind of discern where to pick some of those pullbacks. It's been a really great trade for us. They started their restructuring program about 18 months ago. In addition to right-sizing the brand and reorganizing the strategy, they've done a lot of operating reworking that's really starting to play out in the numbers. They're starting to comp positive on their same-store sales. From a brand perspective, the quality of the clothing has improved tremendously. They're in the right price points right now. They've right-sized their inventory, and they're not going for that college-age graphic demographic. They're going for women more in that 25 to 39-year-old age range that's looking for quality and more trendy type of style. So right-sizing the inventory and getting the pricing right has certainly started to play out, and we're seeing that in their margins and their same-store sales. The other stock I like a lot, I get a lot of pushback on this. Coach is another one that's about a year into their restructuring. They have a new management team. The creative director that they hired last year is one of the best in the industry. So again, that's another brand that's looking to right-size the strategy, get the brand back in focus, and get inventory back under control. So what I think you're going to start to see is they're going to comp with the new creative designer pumping out product, and they're also going to start comping where they're operating on a much better basis. I almost think of, if you want to look at the pairs trade there, like short Coors, long Coach. I think Coors is where Coach was 5 years ago, where they've oversaturated the market on the high end, lower end, and also on the outlets in the bottom end of the range. Too much product, too many stores, too much oversaturation, and I think they're almost losing their brand identity. That's where Coach was 4 or 5 years ago, and you're starting to see them with the restructuring effort come out of that.
Yeah, absolutely. I mean, how can you have kind of an exclusive elite brand if they're just oversaturated in the market? Another one that we had talked about was kind of more in the athleisure trend, Under Armour. What are your long and short-term outlook for Under Armour right now?
I think, again, when you look at consumer discretionary, you're going to have your haves and your have-nots. So in Under Armour, Lulu is another one that's been outperforming. In fact, that just got an upgrade either in the beginning of the week or end of last week. But these are the brands where they have the right product mix, because right now, athletic wear is an actual trend. It's not just for the gym or for yoga. It's an actual trend that you see day to day. So they have the quality of the clothing. They do have the right sponsorships. The Under Armour obviously hitting a home run, even though we're talking about the wrong sport, with Jordan Spieth winning the Masters certainly did help there. You saw a nice little pop on Monday with that. So they just have the right strategy in place where it's all about product, it's all about the right pricing structure, not too over promotional, keeping inventory in check, and basically just following along those supply and demand names. Because I think when you look at athletic apparel, Under Armour, Lulu, I prefer those over Nike, but I really think Under Armour is the space, the name that you want to be in the athletic space.
Yeah, absolutely. I mean, I completely agree. Athleisure is just kind of taking over fashion trends all over the market. Let's shift a little bit more to commodities. What are you looking at in energy sector?
So I think with the energy sector, it's pretty interesting what we've seen with the movement here. As dramatically as we saw the price of oil fall over the last quarter of 2014, there was virtually no support in it. There's been quite a tremendous run over the past couple of weeks there as well. I think a lot of it could be technical. I think a lot of it has to do with the fluctuation that we've seen in the dollars. It's come off of higher levels. But fundamentally, I really don't think anything has changed there, and that's what the key is. I don't think that you're going to see the spikes that we've had in the beginning of 2014. If anything, at best, I think that we'll be stuck within a range of anywhere from $48 to $60. I really don't think we'll break through that $60 level, even with summer driving seasonal demand coming into play. I just think until we see fundamentals improve, whether it's on correcting the supply glut, doing something about storage and increasing refining capacity, nothing has really changed there. And the traders that I speak with virtually every day at the NYMEX, they're seeing the same thing as well. Until things change fundamentally, this trade, and I would argue just about all the other commodities, are trading off of what's happening with the U.S. dollar, and that has nothing to do with the underlying fundamentals. Even if we take a look at gold and some of the other metals, it's really, they're just jockeying around interest rate speculation, whether it's going to be in June or September or the beginning of 2016. In fact, we saw somewhat of a drop in gold this week because there was speculation coming back in that interest rates were going to get a hike in June. So it's every day there's a different rumor, and I did a hit yesterday with a gold trader on the NYMEX, and we basically said the same thing. It's almost like, let's get this interest rate hike out of the way and try and get these commodity complexes back to fundamentals, because you just don't see it right now.
Moving to kind of a general economic outlook, I mean, what's your outlook on interest rates? Do you think we can expect a hike this year?
You know what, I don't know if June is necessarily going to be the time frame. If anything, later in 2015, potentially the beginning of 2016. And quite honestly, an interest rate hike is a sign of a stronger economy. They have to do it. This has to get out of the way. A 0.25% of an interest rate hike is not going to move the needle in the grand scheme of things. You're obviously going to have your initial reaction across all the equity and commodity and treasury markets and so forth, and of course currencies. But I think, at the end of the day, it's a 0.25%, and if you look at it from a longer-term fundamental perspective, it's good. It's showing that our economy can sustain itself on its own, and that has or should have been the goal of the Fed and the central banks globally over the past 5 to 6 years. So in theory, the programs that they've put in place by artificially inflating the market and so forth, we can argue that back and forth all day long. This needs to happen. This is a goal that they've been working towards. So I think fundamentally, long term, it's a good thing.
So are you guys seeing, Jill, this is Garrett, are you guys seeing when you're running your analysis, is there a direct relationship then you're seeing between the decline in energy prices and the increase in consumer spending in the retail, in the retail sector?
I don't think, and if we look at consumer spending data and other retail data, I don't think that was enough to really move the needle. And we're seeing that as the data catches up to what's happening real time. I think, if anything, that lower energy prices impacting jobs within the energy sector is a more important point than having an extra, 100 or 200 bucks in consumers' pockets, because these energy jobs are good paying salary jobs. They're not wage jobs, right? So when these start to get lost, and I think you're going to continue to see consolidation and job loss within that group, that's also going to impact housing markets that have been really strong. In Texas, for example, that's been one of the best economies in the U.S. over the past few years because of what we've seen in the energy boom. So I think that's more impactful than just, buying an extra pair of sneakers or an extra couple sweaters or, a couple more games for your Xbox. I think losing these good salary jobs where they're putting money into banks, or putting money into investments, or putting into money in housing for sure, that's what's more impactful to the economy than discretionary retail sales figures, in my opinion.
Okay. Now, if I go back to your pairs trade and talk about the long coats, short Coors, how does Vera Bradley play into this? Because I remember taking a look at Vera and
You
Coach.
know what? I have never really been a fan of the Vera Bradley brand itself and the stock. I think that's another one where, again, they've oversaturated the product, and I really didn't see the product line as being sustainable as well. So quite honestly, that's just a stock I've never really taken a look at because I've had no interest in it. I just don't see the brand or the pricing power, or it just seems very diluted, and it's kind of stuck in, it's not really higher end, it's not really middle end, it's kind of stuck in its own atmosphere, if you will. And I just think if there's other ideas to trade out there from the longer short side when looking for of a more momentum type of play.
Okay. Yeah, and it's definitely a struggle to play with the retailers too, with everybody's changing desires.
Right, because like I said, it's very discernible when you're looking at retail stocks, and you can find the haves or the have-nots, regardless of what the market's done over the past 6 years with this incredible uptrend that we've really never seen in the history of trading. It's just been so dramatic. You still have been able to pick out your out and underperformers in the retail space. So kind of like to stick with the names that have the restructuring stories. They've kind of already been through the pain over the past 3-4 years as they've right-sized and improving all their operating metrics, and also improving their marketing and brand strategy.
Okay. Well, before I get into some of your input on Intel and a few other tickers, I wanted to ask you if you have any comments on Pacific Sunwear, because that was a stock that I used to like to watch, and they seem to have abandoned their kind of skater group and gone for this new style of tighter clothing.
Yeah, you know what? I've been doing a little bit more research on that as well, and PacSun and Urban were almost the same type of mix, if you will, kind of throwing everything at the wall to see what would stick, especially with the whole graphic T-shirt craze. And PacSun is also starting to right-size its brand and refocus their strategy and what target market that they're trying to go after, because the teen group is very fickle, as you know, and a trend 1 minute is going to certainly be different when you look at the next season, and you're starting to see PacSun do that as well. There's been a couple of upgrades out there, more positive notes for the same reason as well, and you're even seeing it in names like American Eagle. That's another one too, where they're sort of reviewing their marketing strategy and who they're trying to target. So that's another one I'm going to keep on my radar. But for right now, I'm really going to stick to Urban within that space, because I think their restructuring efforts are paying off, and I think that could be a model for other names like PacSun, Aeropostale, American Eagle, which is sort of halfway there.
Jill, you already started to touch on the next thing I was going to ask you about, whereas we have Urban Outfitters who's able to kind of move with the trends. Some of these retailers are still stuck in the first, 10 years of 2000, like Abercrombie and Fitch, Aeropostale.
Mm-hmm.
I mean, they don't like, teens don't like the logo anymore, and some of these retailers just can't seem to find the new trend. I mean, what's your outlook for these? Are they just going to disappear eventually?
Right. Well, Abercrombie's, it's kind of an animal on its own, because in addition to sort of being stuck in that teen space, they have a lot of PR issues as well.
Oh, yeah.
And that is always going to weigh on the stock and perception. And, if people don't like to shop there because of what's happening in the PR world, it's obviously going to impact numbers. I think that's another one that has a lot a lot of right sizing to do as well. I think, I'm sorry, what was the other stock you had asked me about? Abercrombie and...
I think I said Abercrombie, Aeropostale, and
Right.
yeah.
It's what I think is interesting. H&M is a brand that I think has also impacted the Abercrombies, the Aeropostales, the American Eagles, the PacSun, because again, that's a store where it's affordable. I wouldn't say Abercrombie's not affordable, but it has the affordability attached to it. They don't have the brand logos all over the place, and they have plenty of product mix. And that's what the teen market wants. They want more flexibility, and they want the pricing power there as well. In addition to, with H&M, they have a teen market. They also have women, men's, and I believe they also have babies in some of the stores as well. So it's those type of brands that allow the consumers to have the pricing power, and they don't have all the logos, and they constantly have a fresh mix. And I certainly think that has impacted brands like Abercrombie, especially as H&M continues to expand in the U.S.
All right, Joel, thank you. So let me get in then, if I could, into I just want to cover some earnings, perhaps, if we could. I wanted to perhaps get your comments on Intel. That's the big one of the day. It seems like everybody's talking about right now.
You know what? Intel's interesting, and I think if you look at large cap legacy tech overall, whether it's an IBM, Qualcomm, Intel, Cisco, these companies from a legacy perspective have always relied on the fact that they have been legacy brands, and these are big, huge ships that they have to turn around, and they were a little bit late to the game in mobile, in the cloud space, and so forth, and you're starting to see it slowly happen. IBM is starting to talk more about that, and I think what you're seeing with Intel, we could be in the beginning phases of that. We knew the past year or two it was going to be pain. They were doing restructuring there. They were getting out of businesses into new businesses. We know the mobile business has been a loser for them. But what I like from when they guided down a month ago, they came in line. Okay, not a great thing, but at least it wasn't any worse than how they guided down. They're cutting expenses. They reported consolidated results for the PC and the money-losing mobile businesses for the first time, and they posted better than expected profits in the last 4 quarters. So that's some good news. I think a catalyst that you want to look at over the next couple months to the back half of 2015 is going to be the Windows 10 launch. So you're going to start to hear more of that come into play. Obviously, analysts are going to have to readjust their models and their numbers following the earnings report from yesterday. So I'm curious to see how that all starts to come into play. One thing I liked about Intel prior to the earnings print, it wasn't bid up. And the tech space in particular, when you see the names bid up, and Amazon is classic for this, Netflix is another one, Apple's another one, when they're bid up so much into the print, the expectations are incredibly high. And when you have to beat, and you have to beat spectacularly well to keep that momentum going. Intel was not bid up into it. So that's why I think we saw, in addition to some of the things I said in the conference call, it did catch a bid in the after hour. So that's another one that I'm going to start to put on my radar a bit more. I think they're kind of in the beginning phases of its expense and restructuring efforts paying off. So I think this is one of those names where it's an interesting longer-term hold. You're going to have to give yourself some time to play out, to let this thesis play out a bit. In fact, we have a trade on OptionsProfits right now. We have a call spread going out to July. So it's going to let it work a little bit. So as you start to hear more about Windows 10, analysts adjusting their numbers, and starting to hear more of how they're right-sizing this massive ship, you could see there's a couple analysts out there, up to $40 price target, and that's not a bad move from these levels on a name that big. That's a really nice percent return if you have the time to let it play out.
We've had Jill Malandrino on the line. She's the product development manager for OptionsProfits at TheStreet. Great analysis, great look at some of these specific names, overall sectors, commodities, market overview. I don't think there's anything we couldn't talk to you about. Jill, thank you so much for joining us this morning. We'll have to have you back on the show again soon.
Okay. Thanks, Brianna. Thanks, Garrett.